Hi everyone and welcome to this YouTube channel. In this video, we are going to talk about why the rich are getting richer. So before starting this video, please like this video and subscribe to our channel for future updates. The debate over inequality has focused mainly on taxes, fairness, and government. But two new academic papers shed light on one of the biggest drivers of wealth inequality, the higher investment returns of the wealthy. The growing wealth of the rich and the relative stagnation of the middle class are due in large part to diverging incomes, but investments also play an increasingly important role. And it's not just that the wealthy have more investments, they also have better performing investments. One reason, the wealthiest 1% put 3/4 of their savings into investment assets. By contrast, the middle class had 63% of their assets tied up in their homes, with home equity accounting for about a third since they have large mortgage debt. Both found striking differences in returns by wealth class. The top 1% earned an average annual return of 5.91% between 2010 and 2013, far more than the 3.27% earned by the middle three quartiles, and that was due mainly to having more exposure to the stock market. Over the past half-century, disparities in personal incomes have both fallen and risen. Between countries, the difference between the haves and have-nots has declined, thanks primarily to spectacular improvements in China and India. But within most advanced economies, the wealthy have become wealthier. The latter is today's topic. The following chart shows the growth in after-inflation income for the median U.S. household from 1975 through 2019, the period for which the Census Bureau's data are available. Also included is the change in median income for the highest earning 5% of households, along with that of per capita gross domestic product and several goods. All figures are expressed in real terms. These results should not surprise. That higher incomes within the United States have outgrown median wages has been widely discussed, as has the struggle of ordinary workers to outdo inflation. Some items have become relatively cheaper, such as basic foodstuffs and airline flights. And of course, modern technology permits services that previously did not exist. However, many common goods, including oil, houses, and gold, have become costlier for average Americans. This outcome has been caused by shifts in both earned and unearned income. With earned income, elite employees have expanded their negotiating power, spiraling CDO compensation, and the hefty salaries earned by tech workers. In 2018, the median wage at Alphabet, GOG, was almost $250,000, have grabbed the headlines. But college graduates overall have fared well over the past several decades. In contrast, employees who lack college degrees have increasingly been regarded as replaceable. Their wages have languished along with their standing. Corporate successes, the role of unearned income has been less discussed, but is equally relevant. In recent decades, U.S. companies have grown their profits faster than households have increased their incomes. This result has lifted the prices of stocks, which are mostly owned by the higher income households. For the well-positioned, the economic circle has been splendidly virtuous. Although suggestive, this illustration alone does not indicate that stock market shareholders prospered, as this measure of corporate profits, calculated by the Bureau of Economic Analysis, includes both private and publicly traded firms. It could be that privately held businesses thrive while listed companies struggled. Or perhaps public corporations profited handsomely, but for whatever reasons, equity investors refused to pay higher share prices for those greater earnings. However, neither event occurred. Over that 44-year stretch, the capitalization of the U.S. stock market, that is, the cost of buying every listed share, increased dramatically. Even after adjusting for inflation and for the nation's increase in population by computing the statistic on a per capita basis, the amount of dollars invested in listed U.S. equities ballooned by nearly 600%. This figure, too, requires further investigation. If a huge number of privately held firms went public or publicly traded companies issued a barrage of new shares, then the capitalization of the stock market could soar without enriching shareholders. The pie would enlarge, but the slices would not. Happily for equity shareholders, that has not been the case. Since 1975, the after-inflation returns of the S&P 500 have been enormous. Dividends matter. The explanation for this performance is straightforward. First, although many firms have entered the public markets, the dilution caused by their activities has been counterbalanced by the trillions of dollars that companies have spent on share repurchases. These days, the amount of money spent on stock buybacks typically exceeds that used for dividend payouts. Second, and of even greater importance, the total return calculation includes those dividends. They represent additional receipts that are not captured by price-only measurements. The boon of dividend payments makes stocks different from the other elements featured in today's charts. Butter, gold, and oil distribute no cash. For its part, household income consists almost entirely of cash. But the Census Bureau's measure conceals no further benefits. The only item on the previous charts that can be compared with equity investment is home ownership, which also can generate greater gains than the initial numbers suggest, because house purchases are typically leveraged. In short, high-wage earners have never fared better. They are likelier than ever before to have more money than they require for their everyday expenditures. Increasingly, their monies are likely to find their way into equities because of the ubiquity of 401k plans and the growth in registered funds. High-wage earners have received a double boost. Not only have their salaries tended to improve faster than their lower-paid peers, but their stock portfolios have performed better yet. Two sources of income. The table below supports the final claim. It shows the percentage of equity ownership either by holding individual stocks directly or by owning stocks indirectly through funds. For those in the top income decile, the middle income quintile, and the bottom income quintile. It also shows the median dollar amount of equities for those who did own such securities. The differences have been pronounced in 2021, with stocks up 15%, somewhat more for most U.S. equities, somewhat less for foreign securities. The median high-income household has enjoyed about $60,000 in equity appreciation in addition to its earned income. Meanwhile, other households have gained only negligible amounts from their much smaller equity positions. Of course, the stock market isn't usually as ebullient as in 2021. This year has been an extreme case. Nevertheless, over the long term, stock returns should continue to exceed that of income growth because equity performances include the effects of both 1. Profit increases and 2. Dividend payouts. Stocks have a higher expected rate of return than do wages, and the wealthy own a great deal more stocks. In effect, they possess a second source of income that others lack. In a paper on household wealth over the past decade, economist Edward Wolff at New York University found that wealth inequality rose sharply from 2007 to 2010 and has remained largely unchanged since then. Thanks for watching.